There are two aspects. In that article, I showed how the gold price, if you like, moved very similarly to how it moved in Germany after the First World War. And as I'm sure most of your viewers know, that culminated in a collapse of the Reichsmark. And the collapse was absolutely total. So we should, if you like, worry about why it is that the gold price is rising on the same sort of curve, if you like, as it was in the later stages of that hyperinflation. I mean, by the later stages, I mean really from about late 1921 onwards. And I mean, the answer to this is quite simple, and that is that the dollar is, if you like, in the early stages of its final life as a fiat currency. Fiat currencies always come to an end. And the reason they come to an end is that governments, the issuers, if you like, of fiat currencies, use them to supplement their taxes. And it gets to the stage where the debt is built up to such an extent that the whole thing eventually falls over. And that's roughly what we face with the dollar. And of course, because we have a global fiat currency system based on the dollar, it affects all of us everywhere. Your reference to 1929-32, of course, it was the big Wall Street crash, the bear market after the roaring 20s, when you had a similar credit bubble, but this one is far bigger. Also, you had the Smoot-Hawley Tariff Act, which imposed extra prices on imported goods. This time, we've got the uncertainty because a capricious president keeps on changing the numbers, but there is no doubt that the combination of a credit bubble and trade tariffs at the top of that bubble is a lethal combination. This credit bubble will pop. And the reason that we can see that the end of the fiat currency dollar is approaching is because we know what the response to the authorities will be when that bubble pops. Because a popping bubble basically means there's more risk in credit, which means that bond yields will rise, borrowing costs will rise for anyone borrowing overnight or whatever. It doesn't matter what the Fed says the funds rate is. I mean, that's completely immaterial. But, you know, markets look at risk and they have to price that risk, and they will price that risk in the knowledge that the purchasing power of the dollar is falling because that debt is being monetized. It's actually already being monetized because the Treasury is relying increasingly on the issuance of T-bills to fund its deficit, because the cost, if you like, of funding at the long end of the yield curve is just too great for it. And, you know, it's also found that there isn't really the demand out there along the yield curve, if you like, to support the level of financing. I mean, you've got the deficit, and also you've got all the maturing debt, which has to be rolled over. So, there's substantial refinancing problems there, and it's being monetized. Is really what it boils down to. This is very, very bad news. Already being monetized, and then this week we had the Fed turning around and saying, no more QT. Now it's going to be QE, and we're going to knock a quarter point off the Fed funds rate. So you can see that the Fed has switched from trying to manage the inflation problem to trying to stop the economy from sliding into recession. So put all that together, you can see how the ghosts, if you like, of the Reichsbank are on the stage now. They don't really have the knowledge. And if you don't have the knowledge, you can't put two and two together. So it's the combination of that. I mean, bear in mind that the current cohort of economists, bankers, investment managers, whatever, are all trained in macroeconomics, which basically is Keynesianism. And so they don't actually understand economics. I mean, the whole of the Keynesian thing is a myth. It really is. It cuts out human action, and the idea that you can calculate and project from statistics exactly what the outcome will be is arrant nonsense. I mean, it really is. But they all, they don't have any substitute for that. That's the problem. They don't actually understand the legal position of gold either, because gold has been denied as part of the fiat dollar-led system for 54 years. But the fact of the matter is that gold is everyone's money if you like, without counterparty risk. And it's embodied in everybody's common law. So, this is the idea that gold is just a pet rock now, or, whatever they like to call it, is just pure propaganda. And of course, everybody's fallen for it. So there's a huge, great re-education, not just of politicians, but of their advisors, which is necessary before they can really tackle the current problem.
Yes, I do. A part of me does wonder that if that's by the time they get round to doing that properly, it's a case of too little, too late. But I guess we'll watch this space. Brings me nicely onto another article that you've written recently. I believe this was for your friends over at Von Greyer's. And by the way, congratulations on your new position there as well since we last spoke. You mentioned about the importance of property rights and the confiscation of gold. And this is important because a lot of listeners for the Contrarian Capitalist are actually from the USA. So again, if you can, dive into that article and bring to light what people should be paying attention to and what might happen.
Yeah, I mean, basically, nowadays we sort of look back on the events of 1933 when FDR decided to, if you like, ban the ownership of gold, putting it very, very bluntly, and forcing individuals who held gold to swap it for dollars at the current gold standard, which at that time was $20.67 to the ounce. The point about it is that what he did was actually a clever way around property rights. Property rights are sacrosanct in an economy like America's. But at that time, we had an absolutely solid gold standard, which was de facto from, I think, about 1856, and de jure from the Gold Act in 1900. So there's absolutely no question that the dollar, at $20.67 was the equivalent of an ounce of gold. I mean, it was just absolutely simple. So using that basis, he forced everybody to exchange their gold for dollars. There was no confiscation. It was just an enforced swap, if you like, of property. So, of course, the fact that he subsequently devalued the dollar by 40% in 34 was, is a separate issue. That undoubtedly is what he had in mind when he forced everybody to submit their gold.
When we examine the present rise in the gold price, the temptation for many analysts is to treat it as a discrete phenomenon, something untethered from historical precedent. But monetary history rarely repeats in a symmetrical way. Rather, it rhymes through structural patterns, policy errors, and human incentives. And when you compare the dollar's trajectory today with the movement of the Reichsmark in the early phase of its final inflationary collapse, you find an uncomfortable similarity. I do not make this comparison lightly. The Weimar hyperinflation has become a convenient rhetorical crutch for many commentators who scarcely understand what actually transpired. But the data is the data, and the curve is unmistakable. Gold today is rising along a path disturbingly close to that which it followed after late 1921 in Germany, at the point when the currency had already entered an irreversible stage of deterioration, though most of the public did not yet realize it. The underlying mechanism is always the same. Fiat currencies do not collapse because of some abstract notion of mismanagement or because of political incompetence alone. They collapse because governments invariably discover that printing money, whether directly or by monetizing debt, is far easier than maintaining fiscal discipline. And once the state becomes dependent on the alchemy of credit creation, the endgame is only a matter of time. Debt piles up until it becomes mathematically impossible to roll over without further debasement. That is precisely where the dollar now stands. The scale is larger, the structure is global, and the institutional architecture more modern, but the dynamic is unchanged. When you add the burden of a globalized dollar-centric monetary system, the stakes become even higher. Because the dollar is not merely the liability of a single government, it is the foundation for nearly all international trade settlement and reserve structures. Thus, when the dollar begins to lose purchasing power at an accelerating rate, every currency tied to it suffers the same fate, whether they admit it or not. This is why gold is not merely rising in dollar terms. It is rising against sterling, against euros, against yen, against the full spectrum of fiat units. That alone tells you this is systemic. The comparison to the late 1920s and early 1930s in America is equally valid, though the mechanisms differ. In 1929, you had a credit bubble inflated by speculation, leverage, and the belief that the good times would always continue. When the bubble burst, the adjustment was violent, but today's credit bubble is incomparably larger in scale and more deeply embedded in government obligations than anything the world has previously witnessed. Add to that the imposition of trade barriers and tariffs, whether through diplomatic bluster or electoral opportunism, and you recreate the deadly mixture that made the Smoot-Hawley Act so catastrophic in 1930. When global trade slows simultaneously with a credit contraction, fiat currencies come under immense strain. Governments invariably respond by attempting to support demand, which in practice means expanding deficits and printing the money to cover them. We are already witnessing this. The Treasury increasingly relies on short-term T-bills because long-term yields would destabilize its funding costs. Demand for longer maturities has waned, and the rollover burden of existing debt is approaching levels that no rational saver would willingly finance without an enormous premium. The deficit is expanding, and the only realistic buyer of new issuance is the Federal Reserve. That is what monetization means. Whether policymakers choose to call it QE, QT pause, balance sheet adjustment, or any other euphemism is irrelevant. Monetization is monetization. The latest Federal Reserve shift, abandoning its anti-inflation posture and returning toward loosening, simply confirms the trajectory. Inflation targeting is politically fashionable only until recessionary forces reappear, after which the instinct of every central bank is always the same. Protect the banking system, protect the debt markets, and protect the political establishment. The cost is borne by savers whose currency loses purchasing power long before they realize the scale of the decline. And once the public loses confidence in the stability of the currency, the process becomes non-linear. That is what the gold chart is telling us today. Confidence is fracturing. The deeper problem is intellectual. For over 50 years, economic thought has been dominated by Keynesianism and macroeconomic abstractions. These models treat human action as a set of variables to be manipulated rather than as the spontaneous choices of individuals acting under uncertainty. They assume that economies can be fine-tuned through statistical management. They assume that inflation can be controlled by adjusting interest rates like the lever of a machine. And they assume that the currency is simply a neutral medium of account, rather than the most essential institution underpinning civilization itself. This intellectual blindness has created generations of economists, bankers, and policymakers who genuinely believe they can engineer outcomes through intervention. Meanwhile, they have forgotten that money itself is a good, subject to the laws of supply and demand like any other. Increase its quantity relative to the goods and services it denominates, and you debase its purchasing power. It is not complicated. But having abandoned sound money in 1971, every successive administration and central bank has found it easier to cover deficits through currency issuance rather than through genuine economic production or fiscal honesty. The legal dimension is equally misunderstood. Contrary to modern propaganda, gold is not some relic of the past. In nearly every common law jurisdiction, gold remains the ultimate form of property, money without counterparty risk. It is the one asset whose legal identity predates the state and whose monetary role is embedded in centuries of jurisprudence. No matter how many economists dismiss it as a barbarous relic, the fact remains that the only money that has ever survived the complete collapse of empires or fiat regimes is gold or silver. Fiat currencies, by contrast, have a failure rate of nearly 100% throughout history. This brings us to the matter of confiscation and property rights, particularly as they apply to the United States. Many Americans vaguely recall that gold ownership was banned in 1933, but few understand what actually occurred. The Roosevelt administration did not storm homes and seize gold. Such confiscation would have been legally impossible. Instead, the government exploited the fact that the United States still operated under a rigid gold standard, meaning the dollar was legally defined as $20.67 per ounce of gold. By using the legal equivalence between dollars and gold ounces, Roosevelt ordered a compulsory exchange. Citizens were required to deliver their gold to the Treasury and receive dollars in return at the statutory parity.